Good evening, class, and welcome to our performance management class for today. The last time we were here, we talked about discounted cash flows. The main thing we were talking about was capital budgeting, and that was part two when we looked at discounted cash flows and we spoke about compounding and discounting to be opposite of each other. We got a formula for discounting, which is the future value multiplied by your discounting factor. And we said our discounting factor, we got a nice formula, which is 1 plus r, close the bracket, raised to power minus n. That's our discounting factor. We also saw how to use the table to get our discounting factors. Then we looked at annuity, what annuities are. Annuities are when your cash flows are the same every time or each period. Then we saw the annuity formula. Then we talked of perpetuity, when you are receiving a particular amount of money as annuity forever. Then we looked at NPV, which is net present values, which is a a a kind of extension of the discounting factor we are looking at. When we are looking at discounting factor, we are looking at present value. We assumed a lump sum to be collected in just one lump sum in the future. We want to discount them now. So, but what if we have several cash flows coming in every period? We want to find their net present value. And of course, we are investing in a capital project. There will be outflow and there will be inflows. So, what will be the net present value? And what is the decision criteria? We said the decision for net present value will be if the NPV is a positive value. And it means that you're going to make uh, returns. Your returns is going to be higher than your cost of capital. Then we looked at the internal rate of return. So if your internal rate of return, we had a formula which we said the interpolation formula, which we are going to also see. We then said the decision criteria will be if your IRR rather, is higher than the company's minimum returns or minimum uh, rate of return, or even more than the cost of capital. And that was where we ended it. Today, we are going to look at some past questions on this topic. And now we're looking at um, May 2016, question number one. Now, this is an ICANN past question and it's a 30-mark question. Now, let's look at it. Olu Holding PLC prepares its accounts to 31st December each year. It is considering investing in a new computer-controlled production facility on January 1, 2016 at a cost of 50 million naira. Now, what we notice here is January 1, 2016 is our now. So it means that we are standing at January 1, 2016, which is our present time times 0, and we want to spend a cost 50 million. So it means that 50 million is already the real value. Don't need converting it because it is now we are spending it. This will enable Olu Holding PLC to produce a new product which it expects to be able to sell for 4 years. Now, what's the implication? As you are selling this for 4 years, there will be cash flows. At the time of at the end of this time, it's been agreed to sell the new production facility. Now, when they say at the end of this time, it means at the end of 4 years. So I'll be doing something here. I will be um, marking this. This is 4 years, so this is 4. Okay, this is year 0 or time 0, which is now. So this is the cost outflow. Now, at the end of 4 years, which is at this end of this time, it's been agreed to sell the new facility for 1 million naira cash. So this is going to be an inflow to the company, right? Then it says during sales of the product during the year ended December 2016 and the next 3 years are expected to be as follows. Now, the year ended December 31st, 2016, 2017, 2018, 2019. We have all these sales in units. Of course, this is in thousands. Then the variable price, the selling price, unit variable costs, and the fixed overhead costs, excluding depreciation. Fixed overhead costs excluding depreciation, are expected to be as follows during the year ended December 2016, 31st, 2016. Now look at the selling price, look at the variable cost per unit, variable selling and distribution cost, fixed production cost for the year, fixed selling and distribution cost for the year, fixed administrative cost for the year. Now, these are what we have here. Some of these things we have variable and fixed. We have variable production, fixed production, variable selling and distribution, fixed, variable, and all that. So we are not told the following rates of annual inflation are expected for each of the years during 2017 and 2019. For selling price, there will be 5% inflation for each of the years. For production cost, there will be 8%. For selling and distribution cost, there will be 6%. Administrative cost, 5%. The company pays taxation on its profit at the rate of 30%. Half of half with half of this payable in the year in which the profit is earned and the remainder payable in the following year. Investment of this type qualify for tax depreciation at the rate of 25% per annum on reducing balance. The board of directors of Olu Holding PLC has agreed to use a 12% post-tax discount rate to evaluate the investment. Then we are asked here to advise Olu PLC whether the investment is financially worthwhile. That's 17 marks. Then we're asked to calculate the internal rate of return of the investment. That's 8 marks. That makes it 25. Then all these are definitions. So we'll be looking at the definitions because you can get that definitions 1 mark each. at the question, but we want to look at the technical side of this question. Now, how do we know that whether this project will be worthwhile or not? The only way we will know is to look at capital budgeting. Of course, we are not going to be looking at payback period because we didn't take any loan here. And even if we did, payback period is some people usually do payback period to have a kind of idea if the investment is worthwhile. But this question lends itself to discounted cash flow. Discounted cash flow. Then we are also going to not use accounting rate of return. We're not going to use accounting rate of return. Why? Because this question is usually discounted cash flow. Now, how do we know it is a discounted cash flow? Okay, how do we know? Okay, they didn't tell us anything relating to the company's cost of capital. So, because they didn't tell you anything related to the company's cost of capital, it doesn't mean that you cannot look at NPV or IRR. This is because NPV, you can choose any figure, any percentage, and work with it and get your NPV. All right. So that being that. Secondly, because they have inflation rates, because they have inflation, it then means they're looking at also time value of money. And so because they're also looking at it in the time value of money, we will need to use NPV. And now you should know that the discounted cash flow gives a better decision for financial capital budgeting decisions. The, the discounted cash flow gives a better decision. So we are going to be using that. So we will go now and go to our workings here. So we use these notes that we have been using since the beginning of this topic. So I will just start here. I will say, so use a different color of pen so that we know this is icon past question. Question number 1, May 2016. All right, so that's what we are doing. The question is Olu Holding PLC. So we'll take it down. Olu Holding PLC. So to check if investment is financially worthwhile. So that's what we're about to check. So what do we need to do to check? Now this is the years of the, the year ended. And you know, we need to get the cash flows. How do we get the cash flows? So that's what we want to do now. We want to get the cash flow. So the first thing to do is to get the cash flow. So now this is year. So we have okay. So this is year. So we have 0, 1, 2, 3, and 4. So we'll start. We have investments. We'll start with investments. Investments. In year 0, the amount here is 50 million. 50 million. So what do we do now? I want to make this 3 zeros. So this is going to be 50,000. I'll put it in bracket because it's an outflow. Now, there's nothing here. There's nothing here. There is nothing here. When it comes to year 4, he said at this time, it has been agreed to sell the new production facility for 1 million naira. So money is coming in. So this is 1 million naira. It's positive. This one money is going out. It's negative. All right. So we've done that. We now have sales unit. So these are the sales unit now. I will just put the sales unit on top. So I will say this is okay, instead of doing sales unit, I will just say sales revenue. And I'll do that by workings. So this is workings number 1. Of course, in year 0 or times 0, there will be dash. And I will go down here and do my workings. Let me take it to this page. So this is workings. So this is workings. So the first one is sales revenue. How do we get our sales revenue? All right, so we will say this is year 1, this is year 2, this is year 3, and this is year 4. So we'll say this is sales units. The sales unit here 100, 105, 110, 108. Am I correct? Yes, of course, it's in 3 zeros. All right. So now this is the sales unit. Then we have sales price. Okay, so what's the sales price? Sorry, the sales price The sales price here is 1,200 for 2016. So this is what we are going to do. This is going to be 1,200 times. Why am I putting times? I'll come back to it. This is supposed to be, we are looking at inflation. We said the following rates of annual inflation are expected for each of the years during 2017 to 2019. So 2017. So this is 2016, 2016, 2017, 2018, and 2019. So the rate of inflation is 5% on selling price. So what do we do? That means here will be 1,200 times, what is inflation? 5%. How do we add 5%? We simply say 1.05. This 0.05 is 5%. This is 100% plus 5%. So that's it. So it means that 2018 is going to be higher than 2017 by 5%. How do we do that? This is still going to be 1,200 times 1.05. Now this is raised to power 2. So that means this will be raised to power 1, right? Anything raised to power 1 is the same thing. Anything raised to power 2 means this inflation is coming the second time. And of course, this will be 1,200 times 1.05 raised to power 3. Now, I want you to observe the usual, there's a recurring thing here. There is an increase in this inflation 3, 2, 1. What does that tell you? That I can still put 1.05 raised to power 0. When you say raised to power 0, anything raised to power 0 is 1. 1 times 1,002 will still give us the 1,002. So that means because I have raised to power 2 here, no inflation. This is where the inflation starts, the first year of inflation. So this is 0 inflation, first year of inflation, second year, and third year. So that's our selling price. So when we do that, we are going to be getting our revenue. So this is going to be selling price times quantity. So let's work it out now together. Now, this is how we'll do it. We'll start with the one that has raised to power something. 1.05, we have raised to power 0. That will give us 1. And so 1 times 1,200, that will give us 1,200. If you multiply it by 100, that gives you 120,000. So we have our 120,000 here. 120,000. I can as well go up and write it before I come back. 120,000 is here. All right, I'll come back again. So that's how we keep going up and down. All right. Now the next thing now is we'll come back again. 1.05. If we say raised to power 1, it will still give us 1.05. It will still give us 1.05. If you multiply that by 1,200, it gives you 1,260. So it means 5% of 1,200 is, if you add it to its 1,200, 5% is 60. Add it to 1,002, that is 1,260. Now multiply it by the quantity 105. Now that gives you 132,300. 132,300. So 132,300, go straight down and go and record it. 132,300. Just to be sure that's the figure. Yes. Right. We now go to the next one, which is 1.05 raised to power 2. Okay, so that's what it gives us here. Now you multiply it by 1,200, then multiply it by 110. That gives you 145,530. 145,530. 145,530. Go up there and write it. 145,530. 145,530. Okay, my figures are not going straight. 145,530. And let's look at the last one. All right, the last one here is 1.05 raised to power 3. Multiply that by 1,200 and multiply it by 108. That gives you 150,028. 150,028. Take away that point. You want to convert it. You don't want to use points here. Uh-oh. All right. 150,028. 150,028. Do it in such a way I remember that it is 150. All right, so we now have the sales revenue. Okay, so what do we have again? We'll go up. We want the variable production costs per unit. Variable production cost per unit. We'll do that. Variable production cost per unit. So variable production cost. We're not going to do per unit, we're going to be doing for all the units. Of course, this will be dashed within cell now. So we'll go to workings number 2. So working number 2 is variable production costs. So that's it. So we will now look at 2016 to 2019. So this is 2016, 2017, 2018, and 2019. These are the years. Now we'll look at the units, sales units. Again, this is 100, this is 105, this is 110, and this is 108. Now, we are looking at the variable production cost per unit is 750. Variable variable production cost per unit. So this is going to be 750. Of course, we'll start with our times. So we'll come here and do it again. 750 multiplied 750 multiplied. By now, you know why we are doing the multiply. 750. Now, we'll come back again. Variable production cost per unit is 750. We'll now go back to inflation. They said production cost. And what were we doing? We are doing variable production cost. So now we have taken variable costs. This is variable production cost. So 8%. So we'll go back now and we'll say times 1.08 is raised to power 0, 1.08 raised to power 1, 1.08 raised to power 2, 1.08 raised to power 3. So that's the sort of things we'll be doing. For all variable costs, we'll be using the, the sales units. We involve the sales unit in all variable costs because variable cost is per unit. So what do we do now? The first one is, so we know that anything raised to power 0 is 1, so we don't need to go and start testing it again. We have 750 multiplied by 100, and that gives us 75,000. So this is 75,000. 75,000. Okay, so we'll go now and do it here. 75,000. Why are we doing it immediately? So that we'll not be carrying several figures. This is 75,000. Variable cost is an outflow. Come back again. Do the second one. Now we know that anything raised to power 1 is that thing. So we just say 1.08. You don't need to say raised to power 1 because it will give us the same thing. Multiplied by 750, then multiplied by 105. That will give us 85,050. 85,050. So we'll take it straight down here. 85,050. Again, this is 85,050. Okay, then we'll go to the next one. All right. The next one here will be 1.08 raised to power 2, then multiplied by 750 multiplied by 110. And that gives me 96,228. 96,228. take it again down here. 96,228. All right, so I will go to the last one now. The last one, that's going to be 1.08 raised to power 3 multiplied by 750 multiplied by 108. That gives me 102,037. 102,037. I'll take it down. 102,037. That we've done variable production costs. The next one is variable selling and distribution cost per unit. Okay, variable and selling and distribution costs. Okay, all right. 100. What am I doing? 100 variable selling and distribution costs. Variable selling and distribution costs. We do workings 3. Okay, so we'll go down there and do workings 3. Workings 3. Variable selling and distribution costs. Because this is 2016, 2017, 2018, and this is 2019. These are the years. And this is sales unit. Of course, this is 3 zeros. We have 100, 105, 110, 108. Just to be sure that it is correct. All right, correct. Then variable selling and distribution costs per unit. We are told it's 100 naira. So this is going to be 100 multiplied by, we have inflation affecting 100 multiplied by 100 multiplied by 100 multiplied by. What's inflation for selling and distribution costs? What's inflation for selling and distribution cost is 6. So we are taking the variable part, 6%. So we'll say times 1.06 raised to power 0, 1.06 raised to power 1, 1.06 raised to power 2, 1.06 raised to power 3. All right, so this is simply here. Everything here is 1. So this is just simply 100 times 100, which is 10,000. So this is just 10,000 here. I will remember this figure. So let me do the second one. I will take the 2 up. So this other one here is 1.06 times 100 times 105. That's 11,130. This 11,130. So let's take it up and write them. Here is 11,130. This is 10,000. Because this is dash. So let's do the remaining 2. So now this is going to be 1.06 raised to power 2 multiplied by 100 and multiplied by 110. That will give me 12,360. 12,360. So we'll take it down and write it down. 12,360. Now let's do the last one. Last one here will be 1.06 raised to power 3, then multiplied by 100 multiplied by 108. That gives me 12,863. 12,863. 12,863. 12,863. All right, so we have done something here. So we can now go here and what's the next thing? We have production costs for the year. Fixed production cost for the year. Fixed production cost for the year. Now they said the selling price, units, variable cost, fixed overhead costs, excluding depreciation. Excluding depreciation. So here it means that depreciation has not, so excluding depreciation. So depreciation is not involved here. So it means that depreciation has been removed. Assuming that there was depreciation inclusive here, we would have removed depreciation because depreciation is not a cash flow. So all of these things here are cash flow. So fixed production cost for the year is 4 million. So what do? we simply say, let's go and work it out. Fixed production costs. Say fixed production costs. So this is working 4 because this is 0. We know that here will still be 4 million. Let me still bring the 4 million. Okay, but we'll still go and work the rest out. So working is 4. Fixed production costs. 2016, this is 2017, this is 2018, and this is 2019. We now say cost value is going to be 4,000 in each of them, 4,000 in each of them, 4,000 in each of them, 4,000 in each of them. We say inflation index. I would have even done that like that. So all this 100 would have been the same line. Inflation index will just be under. We will now have 10 raised 1.06 10 raised per 1 like that. That's what we would have done, but it's still all good. So inflation index, so it will be 1.0 what? Fixed production cost. Fixed production cost. Let's go and see production cost. Fixed production cost. We have done variable, so now we are in the fixed. We are taking the 8% now. So of course we can't use the selling price on again. So we are taking the 8% now, which is 8%. So we'll say 1.08 raised to power 0, 1.08 raised to power 1, 1.08 raised to power 2, 1.08 raised to power 3. So we close it now. Anything raised to power 0 is 1. 1 times 4,000 is 4,000. All right. So this one we are going to do now. 1.08 multiplied by 4,000. That will give me 4,320. They said it's fixed production cost, not administrative cost. Is production cost are used and it's 8%. We have not touched administrative cost, which is 5%. And this is fixed production cost for the year is 4 million. I'm taking the 3 zeros out. That is why it is 4,000. So I'll be mentioning production costs. I've not mentioned admin costs. So we are on track. Okay, so the next one will be 1.08 raised to power 2 multiplied by 4,000. That will give me 4,666. 4,666. And the next one will be 1.08 raised to power 3 times 4,000. That is 5,039. Okay. So remember why we are doing them and removing the zeros, three zeros. In the case of the other ones here, we remove three zeros from the units. We remove three zeros from the unit. So these ones that does not involve units, these are the full costs. Okay, so we have to now remove that three zeros. So 4,320, 4,666, 4,320, 4,666, 539. All right, so this is fixed production cost. What's the next one? So we've taken this fixed selling and distribution cost for the year. Fixed selling and distribution costs. Of course, this is dash. The other one is 2,000. So taking this, let me do the other one immediately. Fixed admin costs. Fixed admin costs. This is dash. Of course, this is 1,000. So we have taken this. So that's it. So let's go down and see the inflation. So the other one is the first one is fixed selling and distribution costs. Let's try and do that. So that's workings number 4, workings number 5, and workings number 6. Workings number 5, fixed selling, okay, fixed selling and distribution costs. So this is supposed to be 2016, 2017, 2018, and 2019. So, so this is the costs. So this is 2000. Need to remove three zeros here. Consistency, costs, inflation. You get to find it. Then workings number 6, fixed admin costs. So this 2016, 2017, 2018, and 2019. The cost is 1 million. Then we'll talk about the inflation. Inflation, 1 point. I think I can remember this should be 6%, and this should be 5%. Let's confirm. Because selling and distribution is 6. We've taken this. Admin cost is 5. This is always fixed. All right. So 0, All right, so let's do this. We'll be doing them maybe side by side, each other. This is already 2000 as established. This is 1000 as established. All right. Now this is 1.06 multiplied by 1.06 multiplied by 2000. That will give me 2120. 2120. Why this other one will give me 1.05 times 1000, 1050. So this is 1050, 2120, and 1050. Twenty-one, 20, 10, 50. All right. All right. So this is going to be 1.06 raised to power 2 multiplied by 2000. 2247. 2247. Let's do this. 1.05 raised to power 2 multiplied by 1000. 1103. 1103. 2247. All right, so let's go to the last one. 1.06 raised to power 3 multiplied by 2000. 2382. 2382. We'll do the next one. 1.05 raised to power 3 multiplied by 1000. 1158. 1158. 2382. 1158. All right. So, what do we have? We've used all of these costs. We've used all of these selling units. Uh-huh. We've used every cash flow here. We've used every cash flow. And hmm, the company pays tax. The company pays tax on its profits in the rate of 30%, with half of it being payable in the year in which the profit is earned. So we have a profit here, and the remainder being payable in the year following, uh, in the following year. So we need to get the profit. Just a moment. All right. So we have done everything here, and the only thing we have not done here is tax. And we are now going to look at tax. So before we look at the tax, sorry, before we look at tax, let us find out what is happening here. This is cash flow before tax. That is what we want to find. Of course, here will still be 50,000. So let's see what here will be. So let's calculate it one by one. So we have 120,000, 120,000 minus 75,000 minus 10,000 minus 4,000 minus 2,000 minus 1,000. That gives me 28,000 here. So this is 28,000. So this is the second one will be 132,300 minus 85,050 minus 11,130 minus 4,320 minus 2,120 minus 1050, 1050, 28,630. Okay, then the next one will be 145,530 minus 96,228 minus 12,360 minus 4,666 minus 2,247 minus 1,103, 28,926. Okay, then the next one will be 150,028 minus 102,037 minus 12,863 minus 5039 minus 2382 minus 1158 26549. Uh-oh, should be 27, but I need to add this one here. So plus 1000, which I omitted, 27549. Put the 9 first. So this is 27549. So that's the last year. Nothing were in the other years. So this is the cash flow before tax. Okay. Now we will need to remove tax because tax is also a cash flow. Now, I called it cash flow before tax. I didn't call it profit before tax, although it is still profit before tax. But here, they have removed the depreciation. That's fine. And so this is like cash flow. So I will need to do my tax. Before I do that, let me label these workings. Workings 5 and workings 6. So this is my tax payable. So this is workings 7. So we are going to do tax payable, workings 7. So this is workings 7, tax payable. So this is supposed to be 2016, 2017, 2018, and 2019. So the first thing we'll do here is I'll say profit stroke cash flow before tax. I remember here was 28,000. I'll need to be going up and down now to get this. I think I'll take two figures. Of course, we're not paying tax here, so let me just put dash here. 28,630, 28,926. This is 27,546. Is it 546? 27,549. 27,549. Then now, here's the profit before tax. We will need to remove capital allowance, which is the tax depreciation. We say less tax depreciation, otherwise known as capital allowance. So we are going to use workings number 8 to do that. Workings number 8. Then after we remove the depreciation, we will have profit after, okay, we will now have taxable profits. This is taxable profits. This is taxable profit, which is the difference. Then tax rate. What is the tax rate here? We are told that the 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 company pays tax at the rate of what? 30%. So tax rate, I'll say 30%. Let me say 30%. So I will say 0.3, 0.3, 0.3, 0.3. So this is the tax rate. Now this will be tax payable. Tax payable is simply the taxable profit times your tax rate. Then you will now say tax paid. So we'll come back to tax paid. Now we said that what did they say here? With half being payable this year, in which the profit is earned, and the remainder payable to the following year. So I will say, look at it the way I will put it now, tax paid this year, next year, this year, next year. So when we do that, we will now look at the total tax paid, which is what we are going to take to our books. Then we will now, before we take that, we will now want to do our depreciation, which is workings number 8. Number 8, tax depreciation or capital allowance. Okay, and so we told that investments of this type qualify for tax depreciation at a rate of 25% per annum on reducing balancing basis. So this is not straight line depreciation, it is reducing balance. So how do we do reducing balance? Remember, it's 25%. So what we do here is we will say this is 2016, 2017, 2018, 2019. Okay, so we'll say cost stroke tax written down value. So at the beginning of 2016, at the beginning, which is the first, that is year zero, that is the beginning, the investment was 50,000. The investment was 50,000. So what we'll say, depreciation or capital allowance, we will now say 25% of tax written down value. So what it means now is we will say this is 50,000 multiplied by 0.25, which is 25%. That means 12,500 is going. 12,500. So this is going to be 12,500. Then we will say this is ending tax written down value. So this is what it was at the beginning. This is the depreciation. 12,500 is gone. Let's remove 12,500 from 50,000. This is 37,500. So this is 37,500. And we take it up here. This is the beginning, 37,500. And before we continue, let's take this 12,500 and go and put it where I'm supposed to put. This is 12,500. 12,500. We are lessing this 12,500. So let's less it immediately. So 28,000 minus 12,500. And we are getting 15,500 here. So it means this is going to be 15,500. We'll come back. Okay, let's do it straight. 15,500. The tax rate for it is going to be 0.3, which is 4,650. 4,650. And we have said that half of it is paid now. So we just divide by 2. 2,325. 2,325. So 2,325. Then we'll come here. 2,325. We are paying this year. So if we are in 2016, this is the tax we are going to pay. We are carrying the remaining one in 2017. Now let's come to 2017 and do what we are supposed to do. In 2017, we have 37,500. Now, if this were to be straight line depreciation, all of them will have the same value. But now we are going to be using 25% of 37,500. 37,500 times 25%, that's reducing balance. 9375. 9375. I'll come back to this. 9375. Let me take it straight. 9375. We have it here. Now let's remove it from 28,630. We have 19,255. 19,255. Multiply that by 0.3. That gives me 5777. 5777. So I will just divide this by 2. Just divide by 2. I have 2888. 2888. 2888. Don't come and tell me that there's a decimal fraction. We're not doing it to perfection. We've chopped off 3 zeros. And come to think of it, let's just sum this one up and put them where it belongs. This is 2,325. And let's sum this one now. 2888 plus 2,325. 5,213. 5213. Let me confirm. 5213. 52132325. So that's the tax payable. So come back again. And let's finish this capital allowance story. We have 37,500 minus 9,375. That gives me 28,125. 28,125. So we take it straight up again. 28,125. Why are we taking it up? Our ending balance for last year is the beginning balance for this year. So we'll take 25% of it now as our capital allowance. What am I doing? 28,125 multiplied by 0.25. That gives me 7031. 7031. So take that 7031 here. 7031. That's our depreciation. We now less it from, okay, so 7031. We now less it from 28,926. That gives me 21,895. And I'm going to be multiplying it by 0.3. I have 6569. Then I'm going to be dividing this thing by 2. Divide by 2. I have 2284. 3284. Okay, 3284. Now I will come here. Sorry. This is 3284 plus 2888. That gives me 6172. 6172. 6172. All right, so we'll go to the last one. What a lengthy question is this? No wonder it is a question number one type of question. We have 28,125 minus 7,031, and that gives us 21,094. So you take it up again. 21,094. You look for 25% of that. That gives me 5274. 5274. 5274. Let's just finish it off now. 5274. Let's remove this from 21,094. So this is 15,820. 15,820. Now we're not concerned about this 15,820. We are concerned about this 5274. 5274. So let's take this 5274 down here. 5274. So we'll come here. We have to remove it from 27549. That gives us 22275. 22275. Of course, we have to multiply by 0.3. Multiply by 0.3. That gives me 6683. 6683. 6683. Okay. So, sorry, it's supposed to be here. 6683. So we are going to be paying half now. So let's just divide it by 2. We have 3341. 3341. 3341 is now. Let's take that 3341. Okay, plus 3284. 3284. That gives me 6625. 6625. So is this 6625 I'm interested in? Six, 625. All right, this is my tax payable. Now that I have my tax payable, all I will just need to do is my net flow. Net flow. So this remains 50,000. So what will this one be now? I have this figure, so let me just use it immediately. 27,549. 2924. 2924. Rearrange it well. 2924. All right. Now let me do the other ones. 28,000 minus 2325. 25,675. The next one, 28,630 minus 5213. That gives me 23,417. Then we have 28,926 minus 6172. That gives me 22,754. 22,754. I'm seeing somebody is posting a comment. Is it possible to go back to tax payable? It's not possible. Please, when you are watching the video, you can still go back to that to take a whole lot of time. This question has still not finished. Okay, I will still come back to that tax payable. Now, this is net flow. I will just briefly talk about the tax payable. Now, this is tax payable. This is your cash flow before tax, which happens to be this figure. starting from 28 down here. This is the cash flow before tax. So how do we get this tax payable? Now your tax payable is your profit before tax. You apply your tax rate before. But before that, this is profit before depreciation and tax. This is profit before depreciation and tax. So now you need to remove your tax depreciation. Now it means that depreciation is that one qualifies for, you don't need to charge tax on that. Of course, we know depreciation does not involve the movement of cash. So, but depreciation or capital allowance is removed from your cash flow or from your profit, and the remainder is what you are charging to tax. So this is what we have before, and they say this qualifies for, it qualifies for tax depreciation at the rate of 25% per annum. We've done the tax depreciation at 25% per annum, which we did in Workings 8, and we got these figures, which we use in removing, in deducting from these figures we brought. And this is the amount that is being taxable. This 15,500, 19,255, all these are the taxable amounts after you have removed this depreciation. We were told that our tax is at 30%. So our tax is 30%. So this is the tax. When we multiply 30% of this is the tax we are supposed to pay. But we are told that half of this should be paid this year. So half is paying this year. The remaining half will be paid next year. This is 2016. We are taking the remaining one to 2017. Now this is 2017 tax payable. Half of 2017 tax payable will be paid this year. The remainder will be paid next year. Now this is the one we incurred in 2017. This is the one that was brought forward from 2016 that is going to be paid 2017. So when we add this one incurred, half of it for 2017, plus the other half from 2016, we get what we are going to be paying as cash in 2017. This is what we are paying in 2016. This is what we are paying in 2017. This is what we are paying in 2018, which comprise of half of 2018 plus the remainder half of 2017. Maybe I should have been doing arrow like this so that you know that this one is going here, this one is going here. So that's the tax payable. Of course, you know how we calculated our capital allowance, 25% of the tax written down value at the beginning. So this is 50 million or 50,000. 25% of it is capital allowance, which is what we took to that side. When we remove it, is the ending tax written down value. We bring it to the next year, find 25% of it. We get this depreciation or capital allowance. We take it down there. So that's it. So I believe this answers your question. Now we are going to look at, we have not finished. This is a net flow. This is a net flow. And that's interesting. This is an interesting figure, net flow. Now we've used everything now. They said the board of directors has agreed to use a 12% post-tax discount rate to evaluate the project or the investment. So this is post-tax because this is cash flow before tax. Now we've used the tax. So this is the post-tax. I will call it post-taxed. All right. So now they said we're using a post-tax discount rate to evaluate the project. So we'll now say this is our discount factor, 12%. So what it will be now, 12% here in our formula, let's go and use, we'll do our formula 12%. So let's say Watkins, what is that? Watkins 9. Watkins number 9. Watkins number 9. Discount factor 12%. So we will say year 1, 2016, year 2, 2017, year 3, 2018, and year 4, 2019. So this is going to be, our formula is 1 plus r raised to power minus n, isn't it? So this is going to be 1.12. I've added it all, raised to power minus 1. This is going to be 1.12 raised to power minus 2, 1.12 raised to power minus 3, 1.12 raised to power minus 4. So I believe I was not supposed to do a workings for it, but I just want to do workings so that you will know how I got that. 1.12 raised to power minus 1. That will give me 0.8929. 0.8929. 8929. So let me take it straight down. 8929. This is 1. 0.8929. Then this other one will be 1.12 raised to power minus 2. That gives me 0.7972. 7972. Yeah. So we take it here. Take the next one. 1.12 raised to power minus 3. 7118. Take it straight. 7118. And the last one, 1.12 raised to power minus 4. 6355. 6355. So we take it down. All right. So when we multiply, we are having your present value. Then of course you have your net present value. So this is going to be 50 929 22925 22925. Okay, 3417 multiplied by 0.7972. 7972. That will give me 18668. 18668. And the third one would be 22754 multiplied by 0.7118. That will give me 16196. 16196. And the last one will be 20924 multiplied by 0.6355. That's 13297. 13297. Okay, so now that we've gotten the present values, let's get the net present values. Let me add all the positives and less the negative. I'll start from back to front or from right to left. 13297 plus 16196 plus 18668 plus 22925 minus 50,000. That gives me 21086. NPV is 21086. 21086. So project is financially worthwhile and should be embarked on. Why are we accepting this project? Because the NPV is a positive one. The NPV is a positive NPV. Okay, so now we have done this 17-mark question, the 17-mark question that asks us to look if the investment is financially worthwhile. We say yes, it is. Now we are going to calculate the internal rate of return. When we calculate the internal rate of return, let's see what it is. So we are going to look at the B part now. I'll manage this side. I'll say the second part, internal rate of return. So how can I do the internal rate of return? I'll start again. I'll need to do net. Okay, yes, net flow post tax. Still need to do that again. Net flow post tax. So this is for what do I call this one now? Year zero. Let me call this on year zero. Let me just call this on 0. I'll call this on 2016, 2017, 2018, and 2019. So this is 1, 2, 3, and 4. Net flow post tax. So this is 50,000. Then we'll be taking these ones the way it is here. 25,675. 25,675. Come again. 23,417. Come again. 22,754. And the last one will be 20,924. All right, so what will be our discount factor? Discount factor. What's the percentage? We can use any percentage now. Now we want to achieve a negative NPV. And I told us that if we want to achieve a negative NPV, we should increase our discount factor. So we've used 12 now. If we want to get really negative, let's just use 25. 25%. So let's just call this one now. Instead of going to do walk-ins and be coming up and down, we know how we're going to do it. We'll say 25% is, we're going to say 1.25 raised to power 1 minus 1. That gives me 0.8. So here should be 1. Here should be 0.8000 for decimal places. Then we'll say 1.25 raised to power 2 minus 2, 0.64. So this is going to be 0.6400. The third one, 1.25 raised to power minus 3, 0.512, 0.5120. And the last one, 1.25 raised to power minus 4. This is 0.4096. Right. So this is your present values. So this is still going to be 50. So this is going to be, I have this one already here. So I'll just multiply by 2924, and that gives me 8,570. 8,570. Okay, so I will do here 25,675 multiplied by 0.8. Doesn't matter if I put the other zeros. 2540. 2540. I have 23,417 multiplied by 0.64. Doesn't matter if I put the other zeros. 14,987. 14,987. Then the last one I'm going to do here is 22,754 multiplied by 0.512. That's giving me 11,650. 11,650. Then our NPV will be, let's get our NPV here. So start from the end. 8,570 plus 11,650 plus 14,987 plus 20,540 minus 50,000. I'm still getting, okay, 5,000. I wanted to achieve a negative NPV. So for the sake of although you can do with positive NPV, but I just want to achieve a negative NPV. So let's redo this by using like 30%. So let's just redo it by using 30%. So we'll start again. 1.3, that's 30%, raised to power minus 1. 7,692. 7,692. Let's just multiply it straight times 25,675. That gives me 19,750. Let's do that. 19,750. 19,750. Let's do the next one. So I'm going to be cleaning this and this. So we have 1.3 raised to power minus 2, 5917. Multiply it straight with 23,417. That's 13,856. All right, the next one, okay, I'm gonna be cleaning this, cleaning this, clean this, and this. All right, so the next one will be 1.3 raised to power minus 3. That's 4,552. Take it and multiply it straight by 22,754. That gives you 10,357. 10,357. Then the next one is 1.3 raised to power minus 4. That will give you 3501. 0.3501. Multiply it straight with 2924. That gives me 7326. 7326. All right, so now we have it. Let's do our net present value. 7326 plus 10,357 plus 13,856 plus 19,750 minus what shall we do? Minus 50,000. We're still having this. So let's just leave it. We'll not disturb ourselves. 1289. Let's just have it here. 1289. Okay. Let's just leave it here. This is positive NPV. So even if they use 30% as what I was trying to do here is, even though the tax investment rate is 30%, this project should still be done. Maybe perhaps 35%, it may not be done. So, but here we have NPV. So what we'll just do now is we will now use our interpolation formula. We will now want to define what is our NPVA. Then, sorry, we'll start with A. What is our A? Our A happened to be 12%, which we did before. NPVA, we'll get it from here. NPVA 21,086. 21,086. Then our B is, we use 30%. Our NPVB is 1289. So let's use our interpolation formula. Your I arrow is equal to, we said, let's see if we have the formula. No, we didn't get the formula here the other time. The formula should be sorry. The formula should be A plus NPVA all over NPVA minus NPVB multiplied by B minus A percentage. So that's the IR formula. So we have our A here as 12. Of course, this is percentage, plus NPVA is 21,086 all over all over 21,086 minus 1289 multiplied by, this is 30 minus 12. So this is going to be 12% plus, so let's tidy this. So this is going to be, let's do the denominator, 21086 minus 1289. It will give me 19797. Let me copy this, 19797. I'm going to copy it. All right. Then I have 21086 divided by, I'll just paste, divided by, I'll just say my paste, which is Control V. So I've divided it by what I copied before. I have all of these here. Now everything here is 1.0651. 1.0651 multiplied by 30 minus 12 is going to give me 18. So I'm going to yeah 18. So I'm going to multiply everything here by 18. So I have 19.17. So I have 19.17. So this is going to be 12% plus 19.17%, which is, I'll just add this on to 12%, which is 31.17. So 31.17% is your IRR. So it means that any project that IRR is your internal rate of return from this project. So internal rate of return, this is where your NPV is 0. This is where your NPV is 0. So it means that any project that the cost is higher than 31.17, you should not accept it. Because if you use anything above this 31.17, you are going to get a negative NPV. We said if you want to achieve a negative NPV, increase your percentage. If you want to get a positive NPV, reduce your percentage. So anything below 31.17, you get positive NPV. That's why when we use 30, we got 1 point something, 1,289,000. So it means that if your cost of capital, is higher than 31.17, or anything that you are using to appraise the project is one more than, okay, yes, if your cost of capital is more than 31.7, it means you are going to reject that project because it will be too costly for you. So this is your IRR that we have just done here, IRR, and we've done NPV. So that's how this question is being done. We've used the whole of the 2 hours to look at this question because it's a very important question. That's question number 1. So take your time to look at it. And with that, we've come to the end of this topic. At your own time, you can go through November 15, question number 1. A similar thing here, they gave us information, but we were not given inflation. Okay, and here they give us the selling price, variable cost. Now they give us annual fixed overhead exclusive of depreciation, which is the same thing. Now company's depreciation policy is straight line. The one we did before is reducing balance. This is the budgeted capacity, no opening and closing stock, that's fine. All sales are cash, all costs are for cash. Now you are asked to do two things. Prepare a profitability statement. A profitability statement is where you have profit and where you will have like that. Depreciation will be deducted. Okay? Depreciation, look at this depreciation. You will need to put it in the first one to get your profit, because you are getting profit. You need to start with your selling price multiplied by this 100,000 units, variable cost multiplied by 100,000 units, you get your contribution. You now remove your annual fixed overhead, which is exclusive of depreciation, 1,200. You then remove depreciation. Depreciation is how many years? And they are telling you for 6 years. This is 6 years. Okay, so it means that they've given you figures. Okay, this is the capacity for each of the years. 60% capacity, 60, 90% capacity. So you need to use this capacity to know which quantity. Now, we are told that budgeted production capacity budgeted production capacity is 100,000 units. So this is your 100%. So when they say they are going to do 50%, it's going to do 50% of 100,000. This is 100% of 100,000. Like that is 80%, this is 50. So use that to get your quantity for the year. Then you will do your selling price multiplied by quantity, variable cost multiplied by quantity for each of the two machines. Then you put your annual fixed overhead for each year is 1,000,002, 1,000,002. Then you put your depreciation, which you will calculate straight line. It will be the same figure. You put them for the whole 6 years. Then, of course, there's no opening and closing inventory. It's easier for you. So with profitability statement, depreciation must come, and you have profit as your aim. Now, if you are preparing cash flow statement, you can decide to shorten it. After getting your profitability statement, you remove depreciation here. You add back that depreciation you removed. It turns to a cash flow statement. When you add back the depreciation, it becomes cash flow statement. Or you can decide to do it from beginning, but you will not remove depreciation anymore. Of course, they didn't tell you to pay tax. Tax is not here. So the difference between cash flow statement and profitability statement is, in this question, is depreciation is used in profitability statement because you must remove depreciation to get your profit. But cash flow statement, you are adding back the depreciation because it doesn't involve the movement of cash. Then that's it. What's the payback period for the two machines? The payback period for the two machines, when you have gotten your cash flow, it is the cash flow you will use. Or, yeah, it's the cash flow. So you will not use a profit statement. You will use the cash flow. Now, how much are we taking? We are investing how much? How much are we investing? Okay, this first one we're investing 16,500. lifespan is 6 years. This one we are investing 18,300, lifespan is 6 years. So use the cash flow to check the payback period of the two machines. Which one of them will give you the smallest payback period? Then we are now asked to look at the net present value of the two machines. If the acceptable discount rate for the company is 15%, you go back to the cash flow that you've done. Then you use your discounted factor to do it 15%. And that's all. Which of the two machines should the company acquire? Now you may be surprised that your answer for payback period may favor one of the machine. Your answer for the net book value, net present value may favor the other. So you will be faced with a confusion. Which should you acquire? You need to follow the one that supports discounted cash flow. Follow the one that supports MPV. So if anyone, the truth of the matter is, if any investment appraisal is in conflict with MPV, you accept MPV. So MPV is a priority. If you want to test your hands, you can also try your hands at doing IRR. Though it is not given in the question, try your hands and do IRR. And you can be sure that if this question comes out in the exam, this type of questions come out in the exams, you can get it right. So thank you so much. We've been able to do two questions. One of them we solved exhaustively, and the other one I've given you hints on how to solve it. So I want you to try your hands on it and discuss with me if you have any issues about that. So until I come your way in the next class, where another different topic will be discussed, this is your lecturer, Chima, signing out. Thank you and see you in the next class.